Well, investors are grappling with the potential impact of the coronavirus and what that could leave or what that could really impact the global economy. Now, the S&P is on track for its worst loss in months. Joining us now, we have Rachael Aiken, Vice President and Portfolio Manager at Rockland Trust. And we also have Dan Wantrobski, Director of Research at Janney, Montgomery, Scott. And let me start with, Dan, let me start with you just in terms of some of the panic that we are seeing in the market today. We have the Dow off 370 points. Do you think this move to the downside is justified?
Yeah, I mean, I think to some extent it is. You have to remember coming into this scenario out of China, U.S. markets, U.S. large caps in particular, were extremely overbought or extended. It's what we call market froth. Remember, just last week, the S&P hit new secular highs again, and it was up 30% in 2019. So you have a market that has really had a tremendous run, is extremely overbought, and then when you have sort of these exogenous shocks, it could lead to quick profit taking from traders. So I think it's justified, and furthermore, I think we probably have a little bit more downside to go over the short run to reduce a lot of that overbought technical condition. So I think we can continue to see this elevated volatility, at least for the next several sessions, if not a couple of weeks.
Dan, how much more of a move to the downside do you think we could see?
Well, look, in any secular bull market, and we are in a secular bull market, at least that's our position here, but 3 to 5% corrections are standard fare, and quite frankly, 10% corrections are quite frequent in secular bull markets. So if we were to use the recent secular highs in the S&P 500 at around 3,300, 10% off of that gets you to about 3,000 on the S&P. Interestingly enough, that's where the 200-day moving average of the S&P is currently trading. That's an indicator that a lot of traders and investors watch. So I wouldn't be surprised by a correction in the magnitude of anywhere to 3 to 5%, and certainly the possibility of an 8 to 10% correction before we put in a good bottom and resume the bull market once again.
Rachael, what's your perspective on this? Do you think that this is a relatively normal pullback after the strong start to the year that we've had?
So I agree with our other guest in talking about the climb we've had from October, some 11%. And from there, really the market's been looking for an opportunity or perhaps a catalyst to take some of those profits off the table. And this really has investors thinking about perhaps the global growth story, as well as China being a big driver of that global growth in 2020 and looking at an opportunity, again, to take those profits. Where we stood at technical levels being overbought, as we've just spoke about, it makes sense for us to see some type of leg down, and the spike in volatility is something we haven't seen for quite a bit. The heightened volatility and this profit taking gives us a little bit of unease at this moment, but again, the volatility does also present on the flip side some opportunity.
Dan, the other big story that we're watching in the markets, aside from the coronavirus and its impact that it's having on equities today, but also bigger picture, has been earnings. Now, earnings got underway just around 2 weeks ago. When we take a look at the results that we've gotten so far and what we can expect for the rest of this quarter, what's your sense on earnings at this point?
In my opinion, it's come in according to plan. I think what investors are really keying in on is forward guidance and the type of comments, color, and body language that they're getting as CEOs and CFOs present results, but also give us sort of a forward look. And what we found is that the outlook is a little bit more conservative. It's a little bit more uncertain. And so that's, I think, given investors and traders some pause as we move forward. I mean, keep in mind that the S&P from a valuation perspective certainly isn't cheap at its current multiple. I think it's trading 19, 20 times on a trailing 12 basis. Maybe it's 17, 18 times on a forward PE. But at the same time, it's not ridiculously expensive. We don't believe it's peak cycle. We don't think it's, the end of this bull market from a secular perspective by any stretch. But nonetheless, you have a number of macro and geopolitical uncertainties out there, combined with this forward look as we grind through earnings season. And I agree with the other guests that it could lead to some further short-term volatility in equities as we sort of reprice and base and get ready for the next leg up, which could be weeks or perhaps a few months away.
Rachael, if we see some more volatility ahead in the short term, we're seeing some demand for gold, treasury bonds as well today, just in terms of safety plays. Do you still think that there may be more demand for some of these safety investments going forward, at least in the short term?
Yes, so I think it's interesting to look at the fact that we saw the 10-year U.S. Treasury on somewhat of a declining slope prior to the crisis that we're dealing with right now. And again, the bid up in gold is predominantly on fear and on instability. So there could be some more room there. Also, within the global global yield perspective, we want to keep an eye on what's going on outside the U.S. and look at some of the negative yielding areas. Most notably the German Bund, which has taken quite a steep leg down from a negative 15 basis points to a negative 38 basis points on this news. And we need to really figure out, is it the matter at hand today, or is it really a predictor perhaps of the global growth that we're anticipating may not be coming? So to keep an eye on the two stories that are being told between the equity market and the fixed income market.
All right, Rachael Aiken and Dan Wantrobski, thanks for joining me today.